what we do in clients' portfolios, we use different software for that. We use something called Tamarack, which is our rebalancing software. So when people start with us, we figure out what their asset allocation should be. And that's what percentage of stocks, bonds, and if they need cash in their portfolio, how much cash. And then we create a model in Tamarack for that client or assign one that we've used for somebody else. And so we will have an idea of approximately how much, what percent in each fund the client should have. So for example, clients might have, depending on their size, whether they have taxable accounts or not, whether they have multiple accounts or not, generally somewhere between like 8 and 12 or 13 funds for most models. And we will assign the different asset classes. For example, like small cap value might be 4% in a client's portfolio. Well, we use that model to keep track of that. And we had an overall model deviation by how much a client or a client's household is off of their model easily. And then we also have a separate notification if someone is off a particular holding by more than 20%. So if you are supposed to have 4% in small cap value, let's say, if it goes below 3.2% or above 4.8%, we'll get notified. So in one of our screens where someone's out of tolerance, we'll say, oh, Maddie's account is out of tolerance. Let me take a look and see if trade should be made. Now, some computer algorithm is not going to be making that trade. What's going to happen is an adult, mature, responsible financial advisor, maybe even me, will take a look at that and look at the client's overall portfolio and see whether it makes sense to make a trade. And some of the things that we might take into consideration is, what's the size of the trade? Is it really small? Does it make sense to do that? Will there be a transaction charge from Schwab or TD Ameritrade if we make that trade? Is it in a taxable account, and would it be a taxable gain? And is a taxable gain close to the end of the year? So say it's December 31st and we see this trade and it seems to make sense, but the client already has gains for the year and there are no other losses to wash it from. And so I know if I take that gain, there is going to be an immediate tax impact for that client. I will usually wait till January 2nd, 3rd, 4th, whenever to make that trade, if the client is still out of tolerance. So we use software and it's very helpful. And it really makes the decision-making process much easier for us because it's really easy to get the information so that we can make the decision. So in that example, we'll see what the client's long-term gains are, what the gains would be, or short-term gains are, what the gains would be if we made the proposed trade. You know, we'll know the client, so we know what tax brackets they're in. And so it makes the decision-making process so much better. So sorry to say, it's not like some algorithm that just goes bing and a trade is made. It might be nice if it was that easy, but I don't know if that would be as good. I think that we use the tools that are available to us right now. When we pay a lot of money for those tools, and it's a lot of training because sometimes they're, especially Tamarack, is very complicated. But they really, really help. So how's that for a nice long-winded answer that mature, responsible humans do this and not computers?
Yeah, it sounds great. It sounds like a lot goes into it.
Yeah, it is. And, it takes a while to set everything up. And then, we have to monitor the models. We have to monitor the funds. We need to make sure the trades happen. And then, the stock and bond markets are open, 235 days a year. And so people's allocations change. Funds performance is better or worse at different times. And so it's a lot to keep on top of. But I think we do a really good job. We have a tight ship here.